It's easy to place Warren Buffett on a pedestal. After all, he's one of the most iconic investors in history, affectionately called the Oracle of Omaha. But what if we told you his greatness isn't built on rare genius or secret formulas? Buffett's success rests on qualities within reach of anyone: patience, discipline, and a long-term mindset. In this series, we'll journey through Buffett's path, examining not only his strategic evolution, but also the mindset that enabled him to outlast and outperform entire markets for decades. Let's start at the beginning, not in a boardroom, but in a small Midwestern town. Born in 1930 in Omaha, Nebraska, Buffett showed a fascination with numbers and money from an early age. While most kids played with toys, Buffett was selling chewing gum door to door. At just 11 years old, he made his first investment, purchasing shares of City Service, influenced by his father, a stockbroker and U.S. congressman. This wasn't just a kid dabbling in finance. It was the seed of a financial philosophy rooted in compound growth and rational thinking. From an early age, Buffett had a knack for turning simple ventures into profitable ones. He sold newspapers, operated pinball machines in local barbershops, and even filed taxes as a teenager. These weren't random hustles. They were calculated moves by someone who deeply understood the value of time, money, and leverage. Education and the Graham effect. Buffett's academic journey took him from the University of Nebraska to the esteemed halls of Columbia Business School. It was there that he encountered Benjamin Graham, widely regarded as a father of value investing. Graham became more than professor. He was Buffett's mentor, shaping his understanding of intrinsic value, margin of safety, and rational investing. Graham's philosophy centered on the idea that every stock has an intrinsic value, a real worth that can be calculated based on fundamentals. His famous formula, often simplified as a cigar-butt strategy, focused on buying deeply undervalued companies, regardless of their quality. Just like finding a discarded cigar but with one good puff left, Graham taught that even struggling businesses could yield profits if bought cheaply enough. Buffett initially embraced the strategy wholeheartedly. He scoured the market for companies trading far below their intrinsic value, regardless of whether they had long-term viability. He was less concerned with brand strength or management quality, and more focused on whether a business could deliver a quick return. This was value investing in its rawest form, pragmatic, frugal, and opportunistic. But Buffett didn't stop evolving there. The influence of Charlie Munger. Enter Charlie Munger, Buffett's longtime partner and intellectual counterpart. Munger challenged Buffett to look beyond price tags and focus on quality. He believed that it was better to buy a wonderful company at a fair price than a mediocre one at a bargain. This shift changed everything. Buffett started seeking out businesses with durable competitive advantages, what he and Munger referred to as moats. A moat is a company's ability to protect its market share and profitability from competitors. This could come from brand loyalty, cost advantages, distribution networks, or proprietary technology. Think of Coca-Cola. It's not just a drink. It's a globally recognized brand with a distribution empire and a near-religious customer base. Buffett didn't just see sugar water. He saw decades of stable cash flow and deep-rooted consumer trust. That's a moat. From cigar-butts to castles. The transformation from buying cigar-butts to buying castles with moats became the hallmark of Buffett's career. His investment in See's Candies, for example, was a turning point. The company wasn't cheap by Graham standards, but had brand loyalty, pricing power, and consistent earnings. Buffett paid a premium, and it paid off handsomely. Buffett realized that good businesses could grow value exponentially over time, making them superior to undervalued junk. He began prioritizing companies with simple business models, low capital requirements, honest and capable management, and long-term growth prospects. This evolution didn't mean abandoning value investing. On the contrary, it meant refining it. Buffett still sought a margin of safety, but he now placed greater weight on qualitative factors. He started treating stocks not just as pieces of paper, but as ownership in real businesses. What is value investing, really? In Buffett's refined approach, value investing is less about low prices and more about high quality at reasonable prices. It involves a deep analysis of company fundamentals, including revenue growth, profitability, free cash flow, debt levels, and return on equity. But more importantly, it means understanding the business itself. its competitive advantages, market dynamics, and leadership integrity. Buffett believes in buying businesses so resilient and understandable that even a fool could run them, because eventually someone will. He once said, "Invest in a business any idiot could run, because one day one will." This isn't cynicism, it's preparation. The best companies don't just survive leadership changes, they thrive despite them. Moats remain a central theme. Whether it's Disney's emotional connection with audiences, Apple's ecosystem lock-in, or Geico's low-cost insurance model, Buffett looks for economic fortresses. These are businesses that generate consistent cash flow while being protected from competitive erosion, financial health, and simple models. Another cornerstone of Buffett's philosophy is financial conservatism. He avoids companies with excessive debt and favors those with robust balance sheets and strong cash generation. While some leverage can be healthy, excessive borrowing invites disaster. Buffett likes companies that don't just survive downturns but can take advantage of them. He also favors simple businesses. If a company's model is too complex to explain to a fifth grader, it's probably too risky. Buffett stays away from ventures he doesn't fully understand, no matter how promising they may seem. This principle guided him through various market bubbles. He avoided speculative tech stocks in the late 1990s, sat out the crypto craze, and remained skeptical of overhyped innovations. His consistency in following understandable models has been a key to his longevity. The power of patience. Perhaps Buffett's most extraordinary trait is his patience. While other investors trade on headlines, he holds positions for decades. This long-term view allows compounding to work its magic. With an average annual return of around 20% for over half a century, Buffett has outperformed nearly every benchmark. He doesn't try to time the market. He positions himself to outlast it. And that's why his fortune has grown quietly but relentlessly. As you reflect on this first chapter of Buffett's story, ask yourself, are you playing a long game, or are you chasing quick wins? The habits that built Buffett's empire are surprisingly accessible. What's rare is the willingness to stick with them. Think about that. And if this message inspired you, share your reflections in the comments below and pass this video along to someone who needs a new perspective on wealth. Warren Buffett's rise from a stock picker to the steward of a multi-billion-dollar empire is marked not just by sound investments, but by a deepening understanding of business itself. While many investors chase quarterly returns, Buffett chases permanence. He doesn't just buy companies. He commits to them like a marriage, expecting decades of performance, resilience, and alignment with his values. As he evolved from Graham's disciple into his own brand of investor, Buffett continued to build on the foundation of intrinsic value, but began injecting his own principles into the mix. His view on investing matured to include not just numbers but narratives, stories of good companies doing honest work with reliable leadership. In Buffett's world, trust is as important as earnings. One example of this evolution came through his purchase of See's Candies. The company was a seemingly simple confectioner, yet Buffett saw more than chocolate. He saw brand loyalty, repeat customers, pricing power, and a moat sweet enough to fend off competition. This wasn't about liquidation value anymore. It was about lifetime value. See's became a proof of concept, a business that compounded value not just financially, but emotionally. Building moats and buying time. This emotional aspect is often overlooked in investing, but for Buffett, it's central. He invests in companies that resonate with the public, that have woven themselves into the cultural fabric. He has said many times that he avoids businesses he can't understand. But understanding, in Buffett's case, isn't just about revenue models or expense sheets. It's about grasping the soul of the business. Take Coca-Cola. It wasn't just a financial move. It was a philosophical one. Buffett understood that Coke wasn't just a product. It was a ritual, a habit, a legacy. The company's global presence, iconic branding, and distribution empire made it more than a beverage company. It became a perfect example of what Buffett calls an economic moat, a competitive advantage so wide and durable that it protects profits for decades. By investing in companies with strong moats, Buffett effectively bought time. These weren't speculative plays that required constant babysitting. They were self-sustaining machines. With each passing year, they grew stronger, more embedded, and more profitable. Moats allowed Buffett to let compounding do its work, uninterrupted by market noise or competitive disruption. The power of float and the insurance masterstroke. Buffett's genius also emerged in less glamorous areas, like insurance. Most see the insurance business as complex and slow-moving. Buffett saw it as the key to long-term leverage. He began acquiring insurance companies not just for their earnings, but for their float. Float is the money insurance companies hold between collecting premiums and paying claims. It's not technically theirs, but it's money they can invest in the meantime. Buffett recognized that float was interest-free capital, often measured in the billions, which could be deployed into stocks and businesses with higher returns. Companies like Geico and National Indemnity gave Buffett access to massive amounts of float, and with it, he built Berkshire Hathaway into a capital deployment machine. While others scrambled for funding or watched their debt levels rise, Buffett used float to make bold, strategic bets, most notably in companies like Apple, Bank of America, and American Express. Float gave Buffett a near unfair advantage, but it was completely ethical, legal, and built on customer trust. Selling in euphoria, buying in panic. One of Buffett's most quoted aphorisms is, "Be fearful when others are greedy, and greedy when others are fearful." But he doesn't just say it, he lives it. Time and again, Buffett has stepped back when markets got euphoric and leaned in when they were in crisis. This contrarian courage was on full display in 2025. While the S&P 500 hit historic highs, global tensions loomed. Trade wars, inflation spikes, geopolitical risks, and elevated interest rates. Many investors saw endless upside. Buffett saw risk. And so, he did the unthinkable. He began selling. He trimmed his position in Apple, one of his most iconic holdings, and moved significant capital into U.S. Treasuries. This wasn't a panic move. It was preparation. By doing so, Berkshire Hathaway built a cash reserve exceeding $300 billion, enough to buy major corporations outright, with money left over. Buffett was not predicting doom. He was preparing for opportunity. He knew that eventually, the music would stop, and when it did, those dancing too close to the edge would fall. His cash would give him the freedom to act swiftly, buying valuable assets from those who were forced to sell. Simple models, solid pillars. Buffett's investment criteria haven't changed. He still seeks companies with strong balance sheets, simple business models, and trustworthy leadership. He avoids overcomplicated structures and ventures driven by hype. If a company needs a 100-slide deck to explain what it does, Buffett's likely uninterested. His strategy centers on timeless pillars: modest debt, clear value proposition, predictable earnings, scalable potential, honest, competent management, and, perhaps most importantly, emotional detachment. Buffett never falls in love with a stock. He falls in love with what the business is, not what the stock does. The role of patience and time. Over time, Buffett's ability to hold positions long-term has yielded more than just monetary gain. It has built trust. Shareholders trust him. CEOs trust him. Markets trust him. Because he doesn't act impulsively or emotionally, his presence is seen as a stabilizer. He once said, "Our favorite holding period is forever." And while that may be more poetic than literal, it reflects his unique time horizon. Buffett isn't trading. He's partnering. He's not flipping businesses. He's fostering them. And it's here we see perhaps Buffett's most underrated superpower: restraint. The ability to do nothing, to wait, to stay the course, while others chase shiny distractions. Think about it. How often do you let patience guide your decisions? What would your portfolio or your life look like if you focused not on quick wins, but on building something that lasts? If this section sparked any reflections or new perspectives, drop a comment, and let's build a dialogue around long-term thinking. Share this video with someone who needs a reminder that the best investors aren't always the busiest. They're often the stillest. Warren Buffett's track record isn't just a case study in compounding wealth. It's a blueprint for building resilience. While countless investors have burned out, chased trends, or fallen into emotion, Buffett has remained, decade after decade, an emblem of steadiness. But perhaps the most revealing element of his success is how he thinks, not just about businesses or markets, but about human nature. He understands that investing is psychological warfare, against fear, against greed, against the temptation to act. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." In that single sentence, he distilled a lifetime of financial wisdom. The game isn't about being the smartest. It's about being the most composed. And composition isn't built overnight. It's developed through experience, mistakes, self-discipline, and an unwavering commitment to long-term thinking. While others seek shortcuts, Buffett plays the infinite game, where time, not timing, is a true ally. Buffett's response to market irrationality. Markets go through cycles of mania and despair. In the late 1990s, the dot-com bubble lured investors into unproven internet stocks with no profits and vague business models. Buffett stayed out. Critics called him outdated. Then the bubble burst, and Buffett's conservatism looked prophetic. In 2008, while global markets melted down, Buffett wrote his now famous op-ed, "Buy American, I am." While panic swept the world, Buffett was buying quality businesses at discount prices. He didn't catch the bottom. He didn't need to. He knew the market would recover because strong companies always find ways to survive and thrive. Then came 2020. As the pandemic disrupted global economies, Buffett again moved strategically. He exited airline stocks, deeming their future too uncertain, but doubled down on businesses with strong fundamentals. And now, in 2025, his cautious selling during a period of irrational exuberance shows once more his commitment to principle over popularity. The Berkshire Hathaway portfolio. Buffett doesn't chase trends. He builds ecosystems. His Berkshire Hathaway holdings are not just a collection of stocks. They're a web of businesses that reflect his philosophy. From Coca-Cola and Apple to American Express and Bank of America, each company shares core characteristics: brand strength, consistent cash flow, scalable models, and competent leadership. Even beyond equities, Berkshire owns entire companies outright, like Geico, Dairy Queen, and BNSF Railway. These aren't glamorous names, but they're powerful engines of consistent, boring, beautiful profitability. Buffett doesn't need excitement. He needs reliability. And through all of this, he's remained famously frugal. He still lives in the Omaha home he bought in 1958. He eats at McDonald's. He drinks cherry Coke. His simplicity isn't just personal preference. It's a competitive edge. It keeps him grounded, focused, and free from lifestyle inflation that can cloud judgment, legacy, and the power of principles. Buffett is now in his 90s. His portfolio is massive. His letters to shareholders are studied like sacred texts, and his influence has spread beyond finance into leadership, ethics, and philanthropy. He's pledged to give away more than 99% of his wealth. He's inspired others to do the same. But perhaps the most valuable gift Buffett has given isn't monetary. It's philosophical. He's shown the world that greatness is less about brilliance and more about consistency. Less about being right all the time and more about staying right long enough for the math to work. He's a reminder that character, not charisma, is the real foundation of wealth. Buffett's teachings transcend investing. Focus on what you understand. Wait for your pitch. Don't let emotions dictate action. Invest in people, not just numbers. And above all, be patient. Buffett's most enduring quotes. His words carry the weight of decades. Here are a few of the most powerful Buffettisms that continue to guide investors around the world. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Only when the tide goes out do you discover who's been swimming naked. Risk comes from not knowing what you're doing. The most important quality for an investor is temperament, not intellect. Our favorite holding period is forever. Each quote isn't just clever, it's battle-tested. These are insights forged through recessions, recoveries, bubbles, and busts. How to think like Buffett. You don't need billions to apply Buffett's wisdom. What you need is a framework. Learn before you leap. Read, research, reflect. Stick to your circle of competence. Don't invest in what you don't understand. Wait patiently. The best opportunities are often the ones most people overlook. Avoid debt. Financial freedom starts with stability. Think long-term. Let time and compounding be your greatest allies. Buffett built an empire not with secret strategies, but with public principles applied relentlessly. The truth is, most people won't follow this path. Not because they can't, but because they won't. It requires restraint in a world addicted to motion, silence in a world addicted to noise, and focus in a world addicted to distraction. But if you choose this path, if you choose to invest not just money, but attention, character, and time, then Buffett's path can become your own. Before we close, take a moment to check if you're part of our community. A surprising number of people who enjoy this content aren't yet subscribed. Make sure you're not missing out. Hit the subscribe button and turn on notifications so you never miss a new video filled with timeless wisdom and financial insight.